So, hello everyone. Hope all of you are doing fine. I invite all of you for today's session, which will share valuable insights on why ETFs need to be an important part of your portfolio allocation. I have a power packed panel with me to take this discussion forward. So, this brings me to the first question that I want to put to the panel of esteemed speakers. So, the first question is: what is your view on the passive investment products in India, and why you think that passive products, especially ETF, is the next big industry? So, I would like this to be answered first by Nitai. So, Nitai, over to you.
And thank you so much for the opportunity to come here and discuss my views. And like we just saw in the poll, there are not too many people who have actually started investing in ETFs as either a core allocation or a satellite allocation. But I think that's going to change very soon because passive investing, even if it's not something which is very popular at present, is definitely something that is going to be the key investing vehicle as we go forward. And the reason why I say this is, if you look across the markets all over the world, as markets have evolved and as they have become more mature and as the information asymmetry in the market has reduced, you've seen passive investing take the driver's seat. And I believe that the Indian market is really poised for that. And this will happen very soon if it hasn't already happened in a lot of sectors and spaces. For me, passive investing, whether you do it through ETFs or through index funds or any other quant based or rule based fund, I think the important thing here is to understand that the success of such passive investing is really a function of how easily information is available in the market. So if there is not too much information that one market player has over and above what the other market player has, then to be able to create alpha by actively investing becomes very difficult. And I think that is what is leading to the success of passive investing worldwide. And that is what will lead to the success of passive investing in India as well. So in my opinion, this is just the start. And while there is a lot of interest and a lot of market players have entered into this space, and maybe this is maybe about 5-6 years old, but I think as we go along in India, we'll see a huge size of this industry and huge interest from all market participants.
So, Srinivas, the same question to you.
Sure. Firstly, thanks for inviting me to the panel and pleasure to be here today. I would say I'm a bit surprised. I would have thought the number of people, at least on the poll way we've taken, might be a bit on the lower side in terms of ETF, but it looks like the ETFs have been kind of well taken up by the kind of sample of audience that we have here. Why I say so is that, let's put some context to it. I mean, ETF investing started in the late 70s in the US when the Vanguard Group started its first fund. And it's taken nearly 40 years for the passive market in the US to become larger than the active market. In India, when we look at the numbers shared by Amphi, we see that it was about 2% sometime in 2016, but has seen a very high increase to about 16% by the end of financial year 21. So we are, of course, quite well behind the US in terms of the evolution of the market. Again, another point to note is that a lot of money in the ETFs is still predominantly by the EPFO, which is a kind of an institutional money, and the retail money in ETF as a kind of a percentage of overall investor investment in the equity markets is still in single digits. So that's why I'm saying that I'm firstly pleasantly surprised by what I see out of the poll results. Having said that, again, the trends, as Nitai pointed out, are absolutely clear that ETFs are here to stay and grow with the rest of the market. Again, in terms of if we peel the layer a bit, when you look at the exposure of the ETF market in India, about 80% of the money in ETFs are in the Sensex and Nifty ETFs, and about 20% go to the other categories. Again, about 10% are predominantly banking indices and about 10% the PSU index. So we feel as a family office that there's a lot of room for this ETF market to evolve in terms of innovative products, and also the wider investors seeing value in it over time, and it growing and becoming a much bigger part of the market. Those are my initial comments on your question.
Yeah, thanks, Srinivas. On passive products, and where are you on this debate of active versus passive? Because there is a lot of debate going in the market about active and passive. So, as a manufacturer, what is your view on active funds as well as passive funds?
Hi, Vaibhav. Thank you so much for having me on this webinar along with such brilliant guests. But you cannot deny the fact that globally ETFs have grown tremendously in the last 30 years. There are over 7,100 ETFs today with a total AUM of around $9 trillion US dollars. No other idea has seen such an adoption rate is a fact. Both ETFs and mutual funds are pooled investment funds where investors invest and the fund is managed along the lines of a scheme objective. That is what is common to both of them. But the mutual fund, that is the active mutual fund, aims to outperform the benchmark, and returns are dependent on the investments made by the fund manager. ETFs, on the other hand, simply tries to provide the returns of the underlying benchmark. It neither tries to outperform or underperform the market index. It just gives you the market return. In India, I'm starting to see the tide turning. You have already seen the poll kind of indicating some of it. And you cannot, dissociate from the fact that there is a shrinking alpha in the mutual fund space. And along with the low cost and the ability to trade intraday, ETFs have become a compelling investment product as of now. You see, the increasing product spread and the rise of innovation in broking and fintech, companies have also seen or have made ETF investing convenient and inexpensive. This shift where investors want to add ETFs into their portfolios along with active funds is also because of the underperformance of some large cap mutual funds across the category. But the overall aggregate industry level, the performance is lagging, and one cannot shy away from that fact. So this has led to investors becoming cautious about the cost that is being levied. See, every manager and fund goes through a performance cycle, and thus we feel an investor can buy ETFs and take low-cost focused exposures for getting market returns of a particular segment. This reduces the active risk of an investor portfolio and at the same time allows him to take targeted exposure. If investor is also unsure which segment or mutual funds he tries to invest in, he can simply invest in ETFs like, say, the Nifty 50 and get the market returns. I am not in this debate of whether it's active versus passive. I personally feel that we are in such a wonderful phase in India that if we combine active and passive, it can lead to a far better and structured portfolio aimed at good wealth creation in the coming times.
Yeah, thanks, Swarup. So let me, pose the next question for our esteemed panelist. So I want to know that, like we've seen in our introduction, that, ETF is a trend which has started over the last 5 years and, is gaining traction in India. It's a globally, if you see even the last 10, 20 years, ETFs have become a, large part of advisors' portfolios. So how has, the investment strategy evolved over a period of time to accommodate passive products and strategies? And what are the changes that both our esteemed speakers would like to share on what changes they have made in the investment process to stay in times with the current changing scenario and landscape which is happening? So we are seeing that the scenario is changing drastically over the last 2-3 years. A lot of large cap funds are not able to beat the benchmark. So how have they changed their strategy to make sure that passive becomes an important part of their portfolio? So first, I would like Srinivas to take this question.
Sure, Vaibhav. So let me give some context first, and then I'll talk about the changes. So see, we are a single family office. So the starting point for our work is the asset allocation roadmap, where we define saying that where do we want to go as a investment office in terms of various asset classes. on a risk adjusted basis, what kind of returns should the family office generate? And then from there on, then the question comes as to, like, within the asset class, what kind of investments go specifically inside. Now, within the public market equity kind of if we are talking in that context, we have a kind of a open architecture approach where one is obviously we do look at like the mutual funds, whether it is a passive or an active. Again, there are PMS and other privately managed funds which are there out there. And then we also have a direct investing practice which is there in house. So it's kind of there's a good kind of a internal and external competition for capital which is there in the public market space. Now, also, I mean, I'll also talk about what remains the same, because that's also important to understand. Then it's kind of following trends. One is that you always need to have a good kind of understanding of what products are suitable in what market context, and then build it accordingly. That is point number one. Secondly, it's always important to engage, especially when it's an active kind of strategy, engage with the fund manager periodically and understand how they're going about their work, how are they on top of various business cycles and emerging market trends and all that, so that you get a good flavor of what is the rigor in the work that they bring in. And again, it's an iterative process where every year or periodically you review it. You review in terms of asset allocation, again, manager selection, and so on. So it gets better with more and more practice. So that's the context. Now, in terms of investment strategy evolution, I would say 2-3 things which we have done in the last 3-4 years. One is that, of course, on topic, passive is being considered as one of the vehicles for investing. We started about 3 years back, and again, the data is there for everybody to see. When we look at, say, the greater than 1,000 crore AUM funds, it's very easy to see that it's not. Only about roughly about 20% of the funds have beaten the index in 3 out of the 4 years. If I take the last 4 years as kind of a track record. So again, within that, again, the arguments are stronger in case of large cap versus, say, mid cap and small cap. So we have definitely allocated to passive, especially where the money is going in the large cap or the diversified mandate on the public market side. On the again, the active side, just making a comment, maybe slightly off topic, but nevertheless, if it helps. The last 4-5 years have been quite, I would say, unsettling, in a sense that there has been one event after another, right? From Demon, and then you have a GST, and then now more recently COVID, and so on. So what is probably a little more relevant is to choose managers who are able to navigate very quickly in terms of business cycles as they evolve, make the right choices in terms of portfolio. Also, do not expose themselves to very high concentration risks on any specific company or industry, and so on. So that is something we value more now when we are doing manager selection. Again, similar to ETF, we have also started allocating money to factor-based funds, where the decision making is primarily data driven, but there is a smart manager overlay on top of that than purely the traditional kind of fund management work which goes on. So and then again, the third point on the direct equity is, as a family office, we are kind of building an internal muscle around how to kind of allocate more capital on direct equity. Also, we have a point of view on kind of the time horizon we have to invest, as well as we want to invest in companies which have strong long-term growth prospects, have very strong competitive positions, and have very high governance standards. So these are the basic 2-3 things I can talk about in terms of evolution of our work in the last 3-4 years.
Thanks, Srinivas. So Nitai, the same question to you is that, we've seen a trend change for especially the large cap funds, and a lot of money is moving to Nifty 50, or maybe some amount of money moving to even Nifty Next 50, ETFs as well. What are the key changes that you've also, adopted in your practice of investing? Maybe you can share some best practices with all of us.
Like Srinivas was saying, the core for a single family office is the asset allocation, and that's where we also start from. And let's look at first the public equity allocation. Now, in that, the way we look at it is that there is a core diversified portfolio, right, which is mostly predictable in terms of the kind of information that is available, which is mostly into large, well-known companies, which are not just well-known in India, but are target of most of the foreign inflows that happen into India. So that's really the core portfolio that we try and build, which is diversified, goes into the large or mega cap stocks. Then we have a more concentrated growth portfolio within the listed equity, which really goes into creating strong positions into well-researched stocks where there is information asymmetry, where one analyst may have a view which the other analyst may not share. And if that view is correct, then you tend to make huge returns or extraordinary returns. So that's your more concentrated portfolio that you try and build. And then there is a third portfolio, which is a very opportunistic portfolio where you keep switching between, say, large cap, mid cap, small cap, and you try and be with the winner of the moment, right? And obviously, there is a lot of skill needed to be able to do that. So that's for us, that's really active investing. So this is something that was always there as part of our allocation to listed equity, this entire division into core versus concentrated versus opportunistic. Now, what happened with ETFs coming in is that we decided that the core portfolio, which is the diversified portfolio, which we were playing through mutual funds earlier, could be done in a more cost-effective manner by investing into ETFs, right? Because in terms of the alpha that these mutual funds were able to generate, and we've all been talking about it, that alpha has been shrinking. And it's not really a fault of the manager because, if the information is the same with everybody, then it's very difficult to create that alpha, whatever be your skills as a money manager. So ultimately, because of the alpha shrinking, if you were to look at a cost-adjusted alpha, ETFs were scoring much higher as compared to the large cap mutual funds, which are diversified, investing into necessarily the same benchmark, but making some active calls, which was not really generating any alpha. So we thought that let's replace some part of those mutual funds in the core portfolio with ETFs. And that is how we started. The next thing that we realized was that, okay, these ETFs are fine, and we are investing into a Nifty ETF or a Sensex ETF. But then there are certain problems with those because there is some adverse selection that also happens because not all stocks in the Nifty, not all stocks in the Sensex will do well. So can you then create some sort of filters to remove this adverse selection? And then came about the next kind of slew of ETFs, which said that, okay, we'll apply some factor. Let's say we'll apply a quality factor to the Nifty, and we'll filter out those Nifty stocks which are of low quality. And, obviously quality can be judged by multiple things. Similarly, we'll filter out stocks which have high volatility, or we'll filter out stocks which have low momentum. So there could be multiple factors, and based on your view, you decide to get into a factor-based ETF and invest into that. And then, by doing that, you're also trying to, get into the large cap universe, but you are removing the effects of adverse selection. And all this is possible through ETFs, which carry a remarkably low cost as compared to an active fund. So I think that is something which led us to believe that the core portfolio, which is the diversified stock portfolio, can very well be managed through ETFs, whether it is a broad-based index-based ETF or it's a factor-based ETF, and which is what we decided to do. Again, on the fixed income side, something very similar, where we see that if there is an exposure that we want to take into a hold to maturity product, where we don't have a view on interest rates, where we don't have a view on duration, therefore, and we believe that the credit quality is very high, then again, instead of giving that money to an active fund manager who's doing nothing but buying those securities and holding on to it. Why not give that money to an ETF, which is again investing into those securities, holding them till maturity, which is what I would have done if I were to invest in bonds directly. But because of the tax arbitrage that's there in terms of investing directly into bonds versus investing through mutual funds or ETFs, it makes sense to do that through ETFs. So those are the kind of things that I will do wherever I feel that there is the same value to be made, and there is no alpha to be created by doing an active management, and it can be done at a fractional cost. So that's how we have changed our investment strategy really, and we've kind of got in ETFs.
Yeah, thanks, Nitai, for sharing your perspective of how practically you've seen the trends changing over a period of time. And I think so you touched a very, very important thing of how you could create a core and a tactical strategy for ETFs. So this brings me to my next question, which I would want Srinivas to maybe address is how do you use ETFs to create a core and a tactical allocation in your portfolio strategy, and which I think is one of the key themes that we wanted to discuss in today's session.
Sure. I must confess that maybe I'm not the most evolved in terms of application of ETFs as far as people go, but I'll talk about what we have done. See, when we look at ETFs, again, I think Nitai brought out a very good point right at the beginning that these passive or ETF products work the best when the underlying markets are very liquid. So what we have looked at is certainly the application of ETF in a large cap universe is fairly high. So what we have done as a result is that in the overall allocation, about 10 to 15% of the money which goes into large diversified funds, we have kind of moved that money to ETFs. And again, that is something which is an iterative process. We try to examine whether we can do better by either active manager selection or ETFs. So that's something which is an open-ended point we keep re-examining. Now, again, there are some other parts of the market which, let's say the small and mid-cap universe, where active definitely adds a lot of value. So when I look at the data in the kind of the performance of these funds over the last 4 years or so, in the small and mid-cap universe, like I've examined about 30 funds which have a decent track record over a period of time. Almost 3 out of 4 funds beat the NSE small and mid cap index. So they're clearly, as we've been discussing, information asymmetry has a role whereby a more diligent and active fund manager can deliver some alpha. So in that category, again, we still go by the active approach. And in the diversified, we are, I wouldn't say we use ETF too much, but we are looking at, say, factor-based models where decisioning is, say, more programmatic than idiosyncratic. So those kind of experiments we are doing, and then initial results are positive, but again, I would refrain from very strong advocacy of this. I myself need to get convinced in terms of application of this in a broader context in my family office. So those are the things like we've done so far.
Let me pose the next question. My question is to Swarup. Swarup, we already have a lot of asset management companies focusing on ETFs. I want to know how Mirae is differentiating itself in this category. And like we covered these 4 elements of liquidity, fund expense ratio, tracking error, and the AUM, how do you want to differentiate yourselves versus some of the peers which are there in the market?
Vaibhav, as you would know, we decided to venture into the ETF business in India in 2018. In the last 2 years, our focus has been to set the foundation of the business right. This comes from learnings from investor experiences. So our focus has been to provide ETFs to our investors at the right price, to ensure liquidity and intraday tracking prices of the index on the exchange, and most importantly, to reduce the overall cost of investing in an ETF. I feel at this moment, we at Mirae Asset, the ETFs are ready to provide a very distinct advantage over the peers because of what I just stated. we really want to provide the investor experience of investing, a good or improve the investor experience of investing in ETFs in order to reduce cost of transactions and providing the fair pricing on ETFs. We have on our own group company, which is the Mirae Asset Capital Markets, which does the market making of our products. We are lucky to be working with an authorized participant, which is the market maker, which ensures liquidity in all our ETFs with razor thin spread. And this is what probably differentiates us in the market, because we ensure that we fulfill the orders placed by the retail and institutional investors, both on the buy as well as on the sell side, with no extra spread. This has been a great enabler for our clients to have a seamless experience when transacting in ETFs. As a positioning, we position ourselves not only in India, globally as a thematic, ETF player, and some of the products that we've already got into the market, and we are in the process of launching another one, I do believe will differentiate us from the players in the market going forward.
Thanks, Swarup, for sharing your perspective. So I know a lot of work has been done by Srinivas on, what are the most important aspects, he has considered while choosing ETFs. So my next question is to Srinivas that, if, an investor or an advisor were to select an ETF, we covered those 4 factors. How would he rate those 4 factors basis the research he's done, and what are the most important factors that both advisors and investors cannot miss out while selecting ETFs?
Sure. I think first, maybe a broader observation that, as I mentioned in the beginning, that higher the liquidity of the underlying index constituent, lower the tracking error. So that's kind of a inverse correlation between error rate and liquidity. So to put some data around it, when we look at the universe, Sensex ETF generally have a divergence versus underlying benchmark by about 0.1%. I'm talking about all the listed ETFs out there. When we look at Nifty 50, it's about 0.2. When you look at Bank Nifty, it's about 0.5. And again, the next 50, it's about 0.5. So clearly we can see that there is a inverse correlation between the liquidity and the tracking error. So I would say ETFs work best when the underlying markets are very liquid. Now, if we talk about selection within the same category, what I have looked at historically is, of course, the past performance in terms of how well the ETFs track the underlying index. So you will have, say, measures of expense ratio and tracking error and so on. What I suggest is just do a simple check around how it behaves for yourselves in terms of the over time, whether it has faithfully followed the underlying index or not, and try to kind of choose the best in that category. Now, in terms of liquidity, yes, it is important. However, if you are buying off the exchange, liquidity is of paramount importance. You need to see if the product you're purchasing kind of pretty much is mark to market on the underlying benchmark. If, say, you're buying larger blocks, you can also buy them directly from the asset management company, in which case the immediate liquidity doesn't matter much, but maybe at some point of time in the future when you want to sell, that might become an important point. So short of it is that if there are 2 products, one being more liquid than the other in terms of market volumes, I would choose the one with the better liquidity. So that's the other one. I don't know whether I've kind of covered all those 4 points which you talked about, but this is broadly what I look at.
Sure. Thanks, Srinivas.
Yeah.
Maybe Nitai, the same question to you. If I were to ask you based on priority on those 4 factors, which is liquidity, fund expense, tracking, and AUM, how would your tracking, sequence be? Which one would you rate is most important? And any other factor that you feel is relevant while investors and partners choose ETFs?
So, like Srinivas said, I think liquidity and the tracking error are the 2 most important things, of course, because if you are investing as a retail investor, then of course the liquidity on the exchange is very relevant and it needs to be there, and the spread needs to be very, very small. Otherwise, the cost advantage of an ETF goes away if you are paying a huge spread just to transact on the exchange. If you are a larger investor, then of course you can directly deal with the AMC, and the spread is anyway very minimal, but depends on what kind of volumes are you looking to invest or redeem. The liquidity becomes relevant accordingly. The tracking error is important because, of course, the reason why you're investing into an ETF is because it is supposed to track a particular benchmark, which you believe is the right strategy for you. If there is a problem with that ETF tracking that benchmark, then of course that ETF is not the right vehicle for you. But it's very rare that you'll find one ETF tracking, not as well as other ETFs. It's like Srinivas said, it's more a function of the underlying, which really results in high or low tracking error. And if the underlying itself is illiquid, then any ETF that is tracking that particular underlying will have a higher tracking error. So it's very rare that you'll find that one ETF has a lower tracking error. I mean, of course, there are minor variations, but significantly lower tracking error than the other ETFs. That's very rare to find. Having said that, if you find something which has got a consistently low tracking error, and this is again something that Srinivas pointed out, that you need to look at your index or your benchmark, and you need to see how that ETF has performed and how closely it has tracked that benchmark over time to see if it's the right ETF for you. One of the things that's really not a part of these four options, which I would like to see, is also the logic behind the underlying. So what is the index that I'm trying to follow, and is it in line with my view? So if I have a view on equity, or if I have a view on a certain subsection of equity, or a theme or a sector, then is that ETF or is that index adequately representing my view? So for example, if I have a view on financial services, do I have something which is an adequate representative of the entire financial services space? If I have a view on banking, am I getting an index which really represents all the banks in the system? If I have a view that value investing is going to come back in focus as inflation goes up, do I actually get an index or an ETF which is tracking an index where value investing is possible? Or if I look at high quality, do I have an index that really focuses on high quality? And is there an ETF that is tracking that index? So for me, the logic behind the underlying and how it matches with our investment philosophy is also an important factor when selecting an ETF, apart from the ones which we were just discussing.
Thanks, Nitai. And I think so you've raised a very, very important point, which is when we talk about investing, we say passive investing. But when it comes to passive investing, I think it's not always passive. A lot of active work is going to create the right index or the right benchmark which you are tracking. And these indices or benchmarks are created quite actively. So I completely agree with what you've stated, which is a very, very important fact and a factor that investors should be aware of. I think so. Just to add to that point, and since you raised about banking and financial services as a sector, so Swarup, the next question is to you. That Mirae Asset already has a banking and financial services fund on the active side, and recently we are launching. We've launched actually financial services ETF. So what is a thought around having both an active and passive fund? Can you share more lights on that? So Swarup, this question is for you. Yeah, Swarup, you are on mute, please. Swarup, you are on mute.
Oh, sorry. My apologies. The most pertinent question when it comes to, and it's quite natural that when an active manager goes out and launches the same fund, just brings out the basic thought that, our job as a manufacturer is to provide products both on active and passive side, and we will allow our investors or advisors to choose which product suits them better. We have the Nifty 50 ETF and the Next 50 ETF, as well as as well as exposure to the large cap in a similar sort of capacity. Now, when you look at the simplicity of product in which what makes it, this is what makes the ETFs appealing. Our job is to ensure that we give true to label good products and be indifferent on which side it is. Yes, on the active side, we back ourselves in our ability to beat the benchmark. But at the same time, we launch our passive product and let the investor or the advisor choose which is right for them. We are not the right people to choose which is right for them.
Thanks, Swarup. So I'm sure a lot of questions I already see in the panel, and I'm sure the audience want to get uh, the much needed, questions to be answered. So I have one last question for, all our esteemed panelists. Is that we've discussed on how the ETF landscape has been changing. So would like to hear your last comments on how do you see the passive space evolving in the future from both client as well as advisor perspective, and how do you would suggest that ETF be a part of their portfolio as maybe a tactical or a core strategy. So if we can have maybe Nitai take this question first.
Sure, Vaibhav. I think I will go with what you just said a while ago, where you said that there is a lot of active thought that goes behind passive investing. And I think that is really the future that I see for ETFs, where both advisors as well as investors realize that passive investing is not just about putting money into a broad-based index and forgetting about it. I think it goes much beyond that, and it goes to really having a conviction in a particular part of the capital markets, whether equity or fixed income, and then choosing the best vehicle to really execute that conviction. So it doesn't really need to be something which is only very plain vanilla, like a Nifty or a Sensex, but it could really be as complicated as choosing a particular sector or choosing a particular factor-based investing. Now, whether you do it through an ETF, whether you do it through a factor-based or a quant-based, rule-based fund, that's something that will evolve over a period of time based on cost factors, based on many other factors, liquidity, tax concerns, and so on and so forth. But what is relevant for both investors as well as advisors is that the more important thing is to create a view on the asset class and then try and find the best product to execute that view. So today, for example, if I believe that in the US, I'm looking at inflation and I want to invest into, say, energy sector, if I believe that the energy prices are going to go up, I have, or utility companies, I have ETFs which are going to allow me to invest only in those specific themes, where I can just go and buy a utilities ETF and be done with it, if that is my view. So I think as we mature, as the market in India matures, these are the kind of themes that will emerge, and advisors will lead this, where advisors will say that, okay, we feel that in this phase of the market, this is the kind of investment that we need to make. Now let's go out and talk to product manufacturers. If they can construct something which can really help us execute this vision, that there are so many advisors and so many investors interested, they can create such products on the fly. And that will really mature this market like nothing else. So I believe that that's the future that we are going after. And it's up to the advisors and investors to really make that happen along with the product manufacturers.
Thanks, Nitai, for your very visionary response. So the same question to you, Srinivas, is how do you see, what are the trends that you see changing on the ETF landscape over the next maybe 5 or 10 years, or something that you would like to see changing over the next 10 years?
Sure, Vaibhav. So one is that on the core bucket, like you mentioned, the trend is pretty much inexorable, I would say, that ETFs are bound to take more and more share of the overall market. And again, India is by no means you can say a mature market, so you will have active and passive grow side by side. But there is definitely room for passive to grow its share in certain parts of the market where it brings in that low cost, predictable outcomes versus say some of the active funds. On the other less liquid or thematic, I feel it's a more involved choice. So advisors and investors need to think about when they are putting money in, say, a specific thematic fund or a sector fund. They need to have a certain very clear point of view on why they're doing it. What is the time horizon? When will they exit, or is this a long-term structural investment? So that answer would be a bit nuanced, and the market will evolve depending on how kind of value-added products come in that space at the right cost structure. So that is not very clear to me in terms of how that is going, but it will evolve one way or the other. Now, just one point, since we have kind of spent a lot of time on ETFs, I'll also come in the defense of active as a kind of a closing remark, is that, see, the market to function efficiently requires both. So if it is all ETFs, then money kind of becomes very programmatic and non-involved. So then the whole point of doing fundamental research and rational capital allocation for a well-managed company versus a poor managed company doesn't happen if the entire market switches to an ETF. So which is where active will always be there. There will always be a set of active managers who would strive and do better than, say, the average. So I feel rather than an either all, I feel passive reduces complacency for active, and active ensures that there is lubrication in capital allocation, and that happens. So I feel the future is exciting for both. I mean, that's where I would end.
Yeah, sure. Thanks, Srinivas. I think you pointed out a very important thing, that there is a space for both active as well as passive to grow, and I think so. It's very going to be very important. Whichever product can give the best investment experience will continue to grow. So thank you everyone for a very active participation in today's webinar. So happy investing to all of you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.